Welcome back. Well, in his first interview to CNBC TV18 after taking over as MD and CEO of L&T Finance, Sudipta Roy tells CNBC TV18 that they expect to do better than 25% growth in FY25. Our colleague Ritu Singh caught up with him to talk about their business momentum and growth outlook. Listen in to the conversation.
So in terms of the original Lakshya pillars, right, which we had said retailization of greater than 80%, right, CAGR of greater than 25%. In terms of credit quality, we had said GS3 of 3%, NS3 of 1%. And in terms of ROA, we had said that retail ROA between 2.8 to 3%. So these were the original targets, and we had said that we'll achieve them by FY26. As we stand at the end of FY24, the start of FY25, we have more or less achieved, on the retail side, we have more or less achieved all those numbers. If you see retailization at the end of FY24, we were at about 94%. In terms of growths, we were at about 31% CAGR. In terms of our GS3 and NS3, we are well within those marks of 3% and 1% on the retail side. As well as in terms of ROA, retail ROA, we gave the guidance in the analyst call the last quarter. Retail ROA, we had already hit 3.37%. So what we told ourselves is that now that the retail Lakshya guidances have been achieved, right, we sort of reset the guidances. So we said that now we will target retailization of 95%, right, on a console basis, right, and we said that we'll target on a console basis an ROA of 2.8 to 3%, and growth we will keep at 25% CAGR. So more or less, you know, two numbers we have moved to console basis because, you know, on a retail basis we have achieved those numbers, and we are very confident that those numbers probably we will end up achieving slightly before the end of FY26.
How quickly will you be able to completely pare down the wholesale book, and is the sale of the wholesale book an option that you're examining?
So right now, if you see, we started a wholesale book. When we started the Lakshya journey, our wholesale book was about 38,000 crores, right? Right now, at the end of last quarter, you know, we got it down to 5,500 crores. And we told on the analyst call that at the end of 30th April, we are at 4,400 crores. So see, the book which is left on book is largely a standard asset book, and we are in no hurry to pare it down, right? So, you know, we will not go and take a haircut just because, you know, we want to get it off the balance sheet, right? As and when we get good valuation, right, we will consider divestment. But if we don't get good valuation, or if there are no takers for them, we'll run them down at the normal course of sort of amortization.
You know, since the focus very much squarely is on the retail side of the business, just give us a sense of what are the engines of growth you see, and, you know, with this home loan product that you've launched, give us a sense of how you expect this particular vertical to grow for L&T Finance.
So you see, if you look at our positioning, and we are very uniquely positioned as a sort of non-banking financial services company, because we are 50% urban, 50% rural. Very few NBFC companies have equal strengths in rural as well as in urban. If you see our sort of strengths in the rural area, you know, we are one of the market leaders in microfinance and joint lending group loans, right? And then we are one of the market leaders in tractor finance. So these are like two of our large businesses. So we will grow those businesses, and those businesses have been doing quite well. The farm business, especially the tractor business, was sluggish last year, primarily because of bad rains. But because good rains have been projected this year, we expect that business to have a good uptick post maybe August, when we know.
What kind of growth rates are you looking at for FY25?
So FY25, see, we have said that overall our growth rate targets are 25%, right? So as part of Lakshya guidances. So, you know, we expect that we will hit those numbers going forward, right? We expect to do better, but our guidance is that we will hit those numbers at 25% plus.
You know, while within retail, personal loans is a very small part of the book. You told us it's about 5,500 odd crores. But still, given the concerns that the regulator has highlighted with respect to the growth of that business, you said you're going to take it slow, but just set out for us what your sort of targets for that particular segment is. If it's going to, you know, come down from these levels, will you go very slow in growing it?
No, see, we have slowed down personal loans growth in the last 2 quarters. If you see, you know, our average run rate was 1,300 crores a quarter. We slowed it down from 1,300 crores odd to about 850 crores. And then, you know, last quarter we have done about 900 crores, 950 crores odd. So, see, this is a consumption category, right? This is a segment in which there is demand in the market. This segment gives reasonable ROS. And I do believe that if you run a sensible credit risk program, there is money to be made at acceptable risk costs. So given the fact that, we as a company have said as part of our second pillar is that we will build a very strong credit framework, right? We will continue to grow this business like all other lines of business, but we will continue to grow this business in a risk-calibrated fashion and at acceptable growth rates. We will not be growing this business at breakneck speeds, at acceptable growth rates.
All right. A quick word on your cost of borrowing as well. Since the implementation of the higher risk weights for bank lending to NBFCs, even though your rating is not, it's fairly decent at this moment. How's the cost of borrowing panned out? And with the RBI rates where they are, how do you expect it to be?
So in fact, if you see our cost of borrowing, it went up by 1 basis points between Q3 and Q4, right? From 7.81, it went to 7.82. So that has been one of our strengths last year, where our cost of borrowing has been very, very stable. But given that RW increase and given that, now we are all sort of resigned to the fate that, rates are longer, right? The current rate regime will be longer. We expect our sort of rates to go up by anywhere between 30 to 35 basis points over the next financial year from that current levels. So current levels we are at about 7.81, 7.82 odd. So more or less, you can expect a rate sort of to go up to anywhere between 8.1 to 8.15. And that is what we are looking at, right? Okay,
even on the margins, you expect some pressure to continue?
See, one of the things that you have to note is that we had a large wholesale book. As a wholesale book was average yield of about 10.5%, 11%. And our retail is at an average yield of 15.5%, 15%, right? So as a wholesale book pairs off, right, you have retail book replacing it. So anyway, your margin sort of distribution within the book changes. And the retail book is obviously at a very low level of 4,400 crores out right now. Our NIMs are at about 11.25%. We expect a small margin in movement, right? But the fact is that I think we are maybe, we are at the top end of the NIM expansion cycle, right? But obviously we are working on many areas. For example, fees is an area in which we are trying to sort of improve. For example, we have recently got a corporate insurance agency license, corporate license. Previously, we could do insurance only, attachment only at the point of sale, right? As a credit sheet attachment. Now we can actually sell more sophisticated insurance product towards through the cycle. So we're looking at, expanding our fee lines as well. So overall, NIMs and fees, every organization tries to take the NIMs and fees higher, right? So we will, that objective will continue. And what we're doing is that we obviously see maybe a 30-35 basis points increase in our cost of funds over the next 12 months, right? We will try to at least neutralize that.
The management of L&T Finance there in a conversation with Ritu Singh. Time for a short break on Halftime Report. Up next, Aditya Agarwal